Well, good morning, everyone. It's October 7th. It's Monday, and the market's going to open in about an hour and 20 minutes or so. Let's talk about what's on the table this week. The big report, obviously, is Wednesday's FOMC minutes. That's going to happen at 2 p.m. Eastern Time. We have a lot of reports this week, but that's going to be the big one. That's going to give us a good indication of what the Fed is thinking. The good part is this Fed does not leave anything to the imagination. They tell us everything. This Fed is like having a crystal ball. We're not going to raise rates for the remainder of the. They tell us a little too much if you want to know my opinion, but that's not here nor there. So expect FOMC minutes and expect Jerome Powell speaking earlier, and he's also speaking on Tuesday, and he's also speaking today. And what I'm thinking he's going to be speaking, the direction he's going to be heading is economy is slowing down. China tariff war, nothing is being resolved. Rates are going to go lower. That's what I'm thinking he's going to be saying. He could surprise us all and say, well, look, folks, last year employment data, 50-year low. Employment is at a 50-year, unemployment's at a 50-year low. What do we need to lower rates for? But again, he's been going down the road with let's lower rates, let's accommodate the economy. It looks like he's succumbing to the pressure of President Trump. Whether it's intentional or not, we'll probably never find out, and no one cares. Lower rates are good for the stock market, especially when we have a trade war. So this week we're supposed to see more negotiations in regards to the trade war. The stock market rallied over 300 points on Friday as a result of that, and as a result of seeing unemployment being at a 50-year low. Now, remember what I said. I said something very important Friday morning. I said typically when the S&P drifts between the 50-day, that's the 50-day line right here, and the 200-day line, which is right here. I should change the color of it, but anyway, that's the 50, that's the 200. Typically, when it drifts between these two, it does one of two things. It either stagnates, like what we saw here in August and kind of what we saw here more or less, I don't even know when that was. That was in May. Or it bounces really hard. And what I said on Friday morning was, watch the S&P. If it really rallies hard, there's a good chance we're going to come up fast. So typically you see one of two things. You'll see it stagnate here and just kind of sit there for a month, or jump back up. And the fact that we jumped over 300 points on Friday is very positive. And the fact that we already traded above the 50-day moving average is also very positive. Now, is that telling me we're going to go make new highs again? No. But that is telling me that the market is trying to bounce hard. So one of two things is going to happen. We're going to really trade much higher, much faster. Kind of like what you saw here, this type of trading action. Or we're going to stagnate. And we're going to know about that literally before the end of today. If we start really coming up harder today, that's a very good sign that we're getting out of this 50-day, 200-day congestion. But if we kind of slope around here again for the next few days, the odds are really, really strong. We're just going to hang around here for a while. Now, let's talk about sentiment. Momentum levels are neutral, so right now that rubber band is stretched out and there's really no reason for the market momentum to rise or go down. It's kind of neutral right now. So the market's going to have to stand on its own today. Really keep your eye out on whether we start trading right here near the 297 level on the SPY. That's going to be a good sign, or whether we're going to drift back down. If we are, then we're probably going to stay or remain between the 50-day and the 200-day moving average. And my belief is a lot of this will be dictated by what Jerome Powell is saying and what we see coming out of China, all right? But as far as momentum levels, that rubber band is not stretched out. It was really stretched out Friday morning. It was at 135, and I said the market's going to really pull up, or it should pull up, and it did. It went up over 300 points on the Dow, and as you can see here, we gapped up and just kept going straight up. So here's some other catalysts. As far as data, expect volatility to be subdued till Wednesday afternoon. We should start seeing more volatility second half of Wednesday. Also, keep your eye out on the jobless claims, the CPI, consumer sentiment. Those going to be the big reports this week. Those are the big ones. Consumer sentiment is going to be really, really big. Although it's not a typically big report, consumer sentiment is very, very important right now. Jobless claims, very, very important right now. If the number is below, let's see what the sentiment is. Let's take a quick look here. Consensus is 216,000. If the number is below 216,000, if it's like 205,000, that's going to be on the lower end of the scale. If it's over 220,000, that's going to be on the upper end of the scale. If new claims is lower than 216,000, that's going to be positive for the economy. If it's over 220,000, that's going to cause a little ripple in the bond market. Now, let's talk about something really important. I wrote it down here because I can't keep track of this stuff in my head. That's why this little paper here keeps falling down. Earnings this week. We got Delta, Citigroup, and Fastenal. Those are the three major companies. The only one that's really important is Citigroup. Citigroup is the first bank stocks because next week we got a lot of bank stocks coming out. Here's what you need to know. Bank stocks. Earnings are expected to be overall minus 11% on 0.1 negative revenue. That's the expectations. That's what the market is assimilating right now. So if earnings are better than down negative 11%, that's quite a bit because of interest rates. They're real low right now. So if banks are down, say 7% or 8% or 9%, as long as they're not down 11%, that's going to boost bank stocks up. And revenue is literally, if it's flat or zero point 0.1 positive versus negative 0.1 negative, it's going to boost stocks up. If revenue is lower than negative 0.2 or negative 0.01, in other words, if revenue is a hair below neutral, it's going to be bad. But if revenue is, say, neutral or positive 0.1, it's going to be good. And if earnings are above 11% negative, that's going to be positive. So that's what you're looking at. You're looking for banks, and they're going to be reporting all next week. You're looking for them to report at the end of next week that banks did either better than negative 11% earnings compared to last quarter, or revenue was flat or slightly positive. If that's the case, bank stocks will rally. If the revenue is if it's lower than 0.1 negative, or if the numbers are below 11%, which is kind of high, that's low expectations, you can expect bank stocks and consumer staples to drag the market lower. So this week is going to be very important. It's going to be crucial to see where we stand and whether the stock market's going to regain strength above the 50-day line or whether it's going to stay congested, choppy, and range bound. All right, I'll give you guys another update tomorrow. Take care.